All right, guys. Well, happy Monday. Would you guys be excited if I could spend a little bit of time today showing you the path to getting mortgage rates to 5.5%? Would that be good news? What do you guys think? All right. Well, I got one yes, Sharon. Okay. Well, I guess the rest of you guys want rates over 7,
Yeah.
or just maybe aren't answering. There we go. Okay. All right. So, guys, happy Monday. We've got bunch of things we want to share. So, really, two big topics today. One is talking about mortgage rates and some specific reasons and things that could happen that could push rates lower into the fives, maybe even mid fives. The second thing I wanted to talk about, and I want to start with this, is saw a bunch of stuff on the internet over the weekend or on X, kind of scrolling through my feed, talking about is real estate a good investment or not? And I think most of us on the call would agree that real estate is a good investment. But some of your talking heads, some people in New York, the media are saying that real estate's not a good investment. So, does
I've
anybody know
stopped.
who Grant Cardone is?
Oh,
Okay, famous author, sales trainer, speaker, right? He wrote the book 10X. So Grant Cardone for a couple years has actually talked about that buying your primary home wasn't a great investment. And I think it's important to notate that Cardone might be a billionaire with a B because he owns thousands of apartment units. I think like tens of thousands, like an incredible amount of real estate. He actually has a fund called Cardone Capital that's operates like a REIT. So he is very, very much in real estate. I think the point Grant Cardone was making when he said that he wasn't sure if it made sense to buy a primary residence is I think he meant it for himself because he could take his cash and in lieu of buying a $20 million penthouse in Manhattan, he could probably take that $20 million and invest it and earn a greater return somewhere else. And I think the key differentiator is not everybody is Grant Cardone. Not everybody has $20 million to throw at a New York penthouse or some other alternative investment. The average American is talking $20,000 or $50,000 or something like that. So I've got a couple things teed up for you guys here today. And as always, if you want copies of these charts, I've got an Excel spreadsheet that's got some data and some formulas built in where you can do some comparisons for customers to show them what's a better investment. Um, I think it'll combat some of that information. But here's the chart. Can you guys see my screen, Duba?
yes, we're good.
All right. So here's what I saw all over the internet all weekend. Okay. And it shows the historical growth of the S&P 500 vastly outpacing median home prices. And if you go back historically, like my financial advisor will say, the stock market has historically earned a return of 8% or 10% or something like that, right? The last couple of years, there's been 20 to 30 or more percent returns in the stock market measured by the Dow or the S&P or various indexes. And historically, home prices have appreciated slightly above inflation, 3%, 5%. And certainly there's been years where home prices have gone up 10, 20% or more. Um, there's been periods where the market's been flat, similar to there's been periods where the stock market's been flat. And so here's what I want to walk you guys through, okay? And so follow along with this spreadsheet with me, okay? So here is a hypothetical stock market return, okay? If I take $20,000 and in lieu of putting $20,000 down to purchase a home, I put it in an index mutual fund, let's say. And let's say that I picked a really good fund and I earn a 10% rate of return. Okay, so in year one, that $20,000 with the 10% return becomes 22, 24, 26, 29, and after 5 years, my $20,000 investment is $32,000. I've earned an overall 61% rate of return. So let me ask you guys this. If I could promise you right now that you could invest money with me and earn a 61% rate of return over 5 years, would you be happy with that? So give me a yay or a nay.
Yes.
So 100%. I would be very happy with that, right? If someone's like, Mike, give me 20 grand and in 5 years, you'll have returned 61.5%. Sign me up for it, right? And whether it's 20 grand or 200,000 or 20 million, the percentages are still the same. So that's a great rate of return, right? We'd all be very happy with that. Okay. So here's the key differentiator is real estate can be purchased with leverage, aka a mortgage, what we happen to provide, which most people get when they purchase a home. So real estate without leverage, let's say I bought a $400,000 home. And let's say I only saw a 3% rate of return on that real estate. My $400,000 house is now worth 463 after 5 years. It's a 16%, 15.93% rate of return. Um, on the surface, that doesn't sound too attractive when I could have taken my cash and earned 61%. 61 is certainly better than 15.93. But what a lot of these charts fail to mention, and I think where a chart like this, the headline is sensationalism, the quick get someone's attention and try to prove a point. And I think not to get on a tangent, but America has become very susceptible to quick talking point, quick bullet point, quick graft without much context, and then bang, I form an opinion, right? And so I'm sure there were thousands of people online who were like, "See, I told you so. I've been saying that forever. Real estate's a terrible investment." Now on the other side, there's probably people arguing, the other fact, but this chart, what it doesn't tell you is real estate can be purchased with leverage. And so if I'm just comparing a dollar in real estate versus a dollar in stocks, a dollar in the stock market's always going to provide a greater rate of return. Okay. So 61 is greater than 15.93.
Oh,
But here's what it fails to mention. That $400,000 house was likely not purchased with cash. Let's say it was purchased with a 5% down mortgage. And I used $400,000 because in my market, that's about the median home price. And the average first time home buyer is putting down around 5%. And yeah, there's no money down programs, and there's others that are putting 20% down. Um, and so if I take out a mortgage of 380,000 and I put down 20,000, so that's a comparable investment, 20,000 in the stock market, 20,000 to buy a house. Okay. So my home value still goes from 400 to 463,000. My equity, so if my initial loan balance is 380, over time that loan balance is going to go down. After 5 years, I would pay it from 380 to about 361. So I've built $19,000 in equity through amortization. Okay. I put down $20,000. So 19 of paying the loan down, $20,000 of my initial investment. I've got $39,000 in equity. And if I use that same rate of return, my home value has gone up $63,000 from 400 to 463 using that same 3% increase in value. But in that example, because with real estate, I'm working three ways: my initial investment, like a stock, home appreciation, like a stock can appreciate in value, amortization, paying the loan down. I have $100,000 in equity. If my initial investment was $20,000, after 5 years, it's worth 100. That's a 513% rate of return. So you guys tell me what's better, 513 or 61?
shit.
It's not even close, right? And now some people are putting more money down. There's a number of ways you could show this, but the reason why I shared this with you guys today is I do think it's important for us to continue sharing with our customers, especially younger people, first-time homebuyers. We've talked a lot about the average age of a first-time homebuyer went from late 20s in the 80s. It was in the early 30s for many years, in the 90s and early 2000s, 2000 teens, 2012, 13, 14, 15. Now it's increased to 38 years old. And so we have a whole generation of people that have delayed purchasing a home another 10, 15 years. And I think part of the reason for that is the idea that real estate is an investment loses a little bit of traction when you have markets like we've had over the last 20 years, which is a lot of big booms and afterweight a bust, boom during COVID and at least, flat or soft the last couple of years. And so I think it's important to differentiate between the actual rate of return, stocks versus real estate, versus the cash on cash return, stocks versus real estate. And that's really where real estate becomes a powerful vehicle. And that's why most Americans, the vast majority of their wealth is in first their residential real estate, second their retirement account, and then third or anything else would be stocks, bonds that were purchased like outside of a retirement account. So if you guys would like a copy of this, just message whoever you work with on our team. We will get this in your hands. Um, and it's just a great tool to walk through and show the numbers. Most of the formulas are built where it'll calculate the rates of return for you.
Uh,
Um, okay. While I'm on the topic of, we're just going on tangents today here, of information that could be a little bit misleading that you might see online. So a few months ago, the FHA had a guideline change, and it said that non-permanent resident aliens, aka someone here on some kind of a work visa, could not get an FHA government insured mortgage. And at the time, and if you guys are new, we haven't talked politics on a lot of calls here. Um, I'm a Republican. I like the president. If you don't, we can still be friends. But I also think that it's important that if you do support the president, you should also point out policies that they might pass or promote that you disagree with. That certainly goes for the other side as well. Um, and so, about 6 months ago, when this policy was announced by the Trump administration, they really pushed it as part of the illegal immigration crackdown. Um, and I don't feel like disqualifying non-permanent residents from FHA mortgages really solves anything as it pertains to illegal immigration. So, and I say that as someone that, I support the president in most things, not all, but so to get an FHA insured mortgage, do you have to have a U.S. Social Security number? Yes, you do. Do you have to have prior to this, did you have to have some type of legal right to be in the United States? Citizen, green card, work visa? Yes, you did. So when this was passed, the bill or the change basically was like we don't want to allow illegal immigrants to get FHA mortgages. Illegal immigrants can never get an FHA mortgage because they don't have a work visa, they don't have a social security number, they don't have documented income in most cases. They don't have credit oftentimes. So anyway, we didn't like this bill. The reason why I share this today, to get off like the political tangent and personal opinion of was that a smart move or not with FHA, is look at this chart here. And the way this was presented online is that this policy change, which most of us don't agree with, has had a drastic negative impact on the number of FHA loans being issued. And just look at this chart because this is where things online are misleading. And I think it's important to really dig into the facts before we react or share. Doesn't it look like the amount of FHA mortgages has fallen drastically since May when this policy was announced? Just look at the chart. Like you've got like this massive peak here and then almost nothing in May. It looks misleading. It makes it seem like the number of mortgages, FHA loans being issued has fallen off a cliff. Let me tell you what this chart shows. This chart shows the percentage of all FHA mortgages going to people who are no longer eligible because they're here on a work visa, they're not a US citizen, or they don't have a permanent resident green card status. So going back to 2018, it was 1 or 2%. We had a large population influx during the Biden administration, post COVID. Much of that illegal, also legal. Those who came here legally on work visas got a U.S. social, established U.S. credit, were able for us to document their income. The percentage of those people getting FHA mortgages increased, and many of them were FHA because they had less credit history. Therefore, their credit score might not have been as good. Um, Maybe their debt to income ratio was higher because they took whatever job they can get. My stepbrother is trying to move here from Colombia, and he is a very experienced engineer, project management, having a hard time getting a job in the States, very, very educated. And the reason why he's having a hard time getting a job, trying to move here, and he's moving here in 2 weeks, is because it's not a good job market, right? And so he's going to take whatever he can get. Like Sergio's like, whatever job I can get, I'm going to take. Then I'll get here. Then I can find something that's a little bit more, permanent, in his career. So immigrants oftentimes get FHA mortgages because it's the easiest, most flexible. And so you saw the percentage of all FHA loans going to non-permanent resident aliens, um, 1 or 2% historically went up to four, just north of four, 5, almost hit 6%. Of course, it went to zero in June, July, and August because it doesn't allow them to get an FHA mortgage anymore. And so the reason why I share this chart with you guys is you see this in whoever is pushing this agenda, and it's not a political thing. This is like the media. The agenda they want to push is, oh my gosh, the sky's falling, right? Only 5% at the peak of all FHA mortgages were issued to people that were non-permanent resident aliens. And so even though I don't agree with the policy, I wish that we could continue offering that program. Less than 5% of people getting FHA mortgages were actually affected, which is a very, very small percentage. And so just I found this and it kind of ticked me off a little bit of the weekend, as oftentimes sometimes things on the internet do, because it's just pushing an agenda that is the media or whoever posted agenda without really getting into the facts. Um, and that said, kind of to put a button on this, someone who is a non-permanent resident can still get a conventional mortgage. So there's still options for them, although we don't have FHA. Okay. Let me move on to the second main topic, and hopefully you guys are following along with that, and hopefully I didn't go too far down a tangent, but you see stuff online, and oftentimes it's skewed one way or the other, and I think it's important for us to analyze it, make our own decision before we share it too quickly. Okay, so I'm going to pull up a couple things here. So this is a really good article. It's from a couple years ago. I found on Axios, just Googling. I'm going to post this in the chat here. Um, and it talks about the spread between the 10-year treasury and mortgage rates. And it's something that you've probably heard us talk about on this call a little bit over the past few months. Um, it's starting to improve, which is one reason why mortgage rates are coming down. So historically, the difference between the 10-year treasury, which today is around 4%, and 30-year fixed rate mortgages has been between 1.5% and 2%. And you can see this chart goes back to 2010. And for many, years from like 2011 to 2020, the difference between 30-year fixed rate mortgages and the 10-year was about 1.5% to 2%. Spiked during COVID, was pretty volatile. But then the last couple of years, it's been north of 2.5%. At the end of 2024, it was 2.61%. It reached almost 3%. Okay. So I posted that link in the chat. All right. The second article I want to share or image, this is the US 10-year Treasury. And I'm going to post this link in the chat here as well. And this shows the 10-year Treasury going back to the late 90s. And mortgage rates are loosely tied to the 10-year. When you see the 10-year below 3% or 2% for many, many years, that's when we had that almost decade of rates below five, like 2012 and on. And then the 10-year spiked here post COVID, got up to 5% almost at the peak, 2023, 2024, which is why mortgage rates hit a 20 or 30-year high. So the highest we've seen the 10-year treasury, since really like kind of pre 2008 crash, was the last couple years. Okay. So I'm going to share that with you guys. And to tie this all together, so I threw this chart together here. So, and these are not exact numbers, these are an illustration, but I want to show you what's the path to getting rates into the fives. So in 2023, the 10-year treasury was around 5%. That was at the peak of this cycle. The spread between the 10-year and mortgage rates got up as high as 2.8%. Okay, if I add the two together, the 30-year fixed rate mortgage was up around 8%. We got north of 7.5 for a brief period of time in 2023. Certainly not fun times for any of us or our customers. Um, Over the past couple of years, and there's been some ebbs and flows and volatility within that, but generally speaking, since 2023, the 10-year Treasury has been trending lower as inflation has slowly cooled. And it hasn't been a straight line down. There's been periods of time like last fall where inflation spiked, the 10-year went up. But if I drew a chart directly linking like 2023 to today, it's gonna go down with some ups and downs within there. So in this illustration, 4.5% in 2024. And then today, right now, in fact, last Thursday was the first time the 10-year closed below 4% this cycle, which is really, really good news. So the 10-year has gone from around 5% to 4%. It's gone down about 1 point or 100 basis points. Um, the reason why mortgage rates have come down farther than that is the spread between the 10-year and 30-year fixed rate mortgages has also shrunk, not at historical levels under 2%, but it's getting closer. And so that spread went from like 2.8 to 2.5. And today, the spread between the 10-year and 30-year fixed rate mortgages is around 2.25%. As a result, where are mortgage rates today? Somewhere in the low sixes, right? Four plus 2.25 is 6.25. Rates are somewhere in that ballpark. And again, that's at everyday ebb and flow as the 10-year moves. That spread ebbs and flows a little bit. But generally speaking, what do we see happening? We see the 10-year coming down and we see the spread shrinking. Therefore, not only are mortgage rates coming down because of one factor, they're coming down because of two factors. And if we project ahead over the next 6 months, a year or so, there's many prognosticators that are projecting the 10-year at 3.5, 3.6, 3.8% over the next 6 to 12 months. If the 10-year continues drifting lower, and why would the 10-year drift lower? It's the same reasons why mortgage rates come down. Lower inflation, weak economy, weak jobs reports, things like that. Um, I've got two questions in here. So Mike and Sharon, why is the spread shrunk? So volatility will increase that spread. So let me jump back into that article and just so you can see kind of periods of time where that spread increased. So here we go. So volatility during the COVID recession, both pre and post. If I drew this back like closer to 2008 and 9, um, that spread shrink post '08. So this is kind of normalcy, 1.5 to 2% spread. Volatility drives things higher, and then higher inflation drives the spread as well. Um, Another reason for the spread, and not to get too complicated, when mortgage rates move higher, there is a lack of appetite to buy mortgage bonds. And that's counterintuitive because most people would think that when rates are higher, more people want to buy mortgage bonds as an investment. When rates get too high, like they did in 23, part of 24, most people looking long term, if you're trying to buy a bond, like a treasury or mortgage bond, that's what a long term investment. And when rates peaked at kind of 20, 30, 40-year highs, most people at that point expected rates would come down. I wouldn't want to buy a bond when they're at 7% if I'm expecting them to come down. So, but I think the big picture answer to that question for you guys is um, is more normalcy. Just a more kind of stable, non post COVID volatile market is kind of the big picture, easy answer. Um, okay, so that spread, if that's drifting lower, so if we get a 10-year at 3.5 and a 2% spread, there's a 5.5% mortgage. What if the 10-year gets to 3.8%, which could happen over the next 90 days? And let's say you get a mortgage spread, not 2.25, let's say it goes down to 2.15, you're below 6%. And all of the polling that we've seen when they've asked homeowners, first time home buyers, move up buyers, at what point will you enter the market? Typically, it's when the mortgage rate starts with the five. And we've been talking about that for months that and we talked a lot about it last week that we expect when rates go sub six, buyers come back into the market, move up buyers, first time home buyers, invest all of the above, right? That creates more demand, that stabilizes prices and probably pushes prices higher. So Timmy, this is another tool to share with buyers. The reason why you might take action sooner than later is there is a lot of momentum drifting rates lower, not just with cooler inflation, weaker economy, weak jobs that would bring the 10-year down, but as that spread normalizes as well between the 10-year and mortgage rates, that's going to bring rates down. And so you can see a very clear path, 3.6 10-year 2% spread, 5.6 mortgage rates. There's a very clear path in the next 3, 6, 9 months to seeing mortgage rates sub 6%, which, you know, whole separate call. We all, I think, would agree that that's, would be very positive for the real estate market. Okay. The last thing I've got, and if there's any questions, certainly pop them in the chat or ask them if there's any. So last week, Chairman Powell, in a speech, talked about what's called quantitative tightening. And so let me give you a real estate analogy. So you have quantitative easing and quantitative tightening, which are fancy Fed terms meant to confuse us all. Okay. Quantitative easing is the Fed buying mortgage bonds and treasury bonds as a way to artificially drive bond prices down or interest rates down. So, how did we hit all-time low interest rates in 2020 and 2021? It was the Fed, and that was quantitative easing, buying mortgage bonds. Okay, pretend like that is hedge funds, private equity buying thousands and thousands and thousands of residential properties. What did that do to prices? That certainly rose prices because of competition. Quantitative tightening is the opposite. So, quantitative tightening is the Fed not buying mortgage bonds and letting bonds mature in their what it's called balance sheet runoff, basically less artificial stimulating rates lower. In fact, it's the opposite because the Fed is dumping mortgage bonds. They're not buying ones that mature. That somewhat artificially pushes rates higher. And so the Fed has kind of been like a headwind, kind of acting against us to a degree, preventing rates from coming lower. To use a real estate analogy, okay, in Orlando, what if all of the hedge funds that bought thousands of residential properties as rentals, what if they all decided to list them next month? What would that do to home prices? It certainly would push home values down because it would flood the market with inventory. And so, what are these hedge funds done? And I don't know if there's a couple of realtors I'm sure that are on today that like work with some of those hedge funds or private equity. They're not dumping all of their properties on the market at once. They're strategically putting properties on the market and selling to get their cash investment back without disturbing the market by flooding it with inventory, which would cause prices to go down. What's the Fed doing? The Fed is easing off in kind of the hedge fund real estate analogy. They're easing off selling properties. The Fed is going to stop what they call balance sheet runoff or stop QT or quantitative tightening. Chairman Powell talked about that last week and kind of floated the idea. And typically, what the Fed does is they floated an idea in a speech and then they make it policy and implement it at a meeting. And so, when is the Fed's next meeting? The Fed's next meeting is October 29th. So next Wednesday, 100% guarantee, 98.9%, I guess, if we, use the those polled. The Fed's going to cut the Fed funds rate. The market expects it. That's already priced in. The big news next Wednesday could be if the Fed implements the end of QT or quantitative tightening. That would be another push to lower mortgage rates. So there's a lot of, we've been going against headwinds the last couple of years. We've got some tailwinds behind us that should continue drifting rates lower. So um, all positive news on the interest rate front. Um, Real quick, we'll pull up the chart and then we'll let you guys get off. We're a couple minutes over. We continue seeing bond pricing move higher. Last week, I shared this orange line, this 25-day moving average. You can see last week we had a nice week and we bounced above that. That trend of bond pricing going up is still continuing. Bond pricing going up means yields and rates are going down. So positive movement really overall from an interest rate trend. Um, and Aaron threw some comments in here if you guys want to read it about the 10-year treasury and mortgage rates, a little bit of commentary there. I think I got all the questions answered. We are 3 minutes past due, so I will let you guys jump off today if there's not any questions. Have a great day. Have a great week. We will see you guys next Monday. This Friday, we may get the jobs report released, so keep an eye on that. I know we're still waiting on the September jobs report, but with the government shutdown, it hasn't happened. So may see something in that this week, which could be a market mover. And then next week, all eyes are in the Fed. So have a great day, everybody. Have a great week, and we will see you guys next Monday. Thanks, everybody.